Okay, welcome back everyone. Michael Steady here once again, and welcome to the video called The 5 Dirty Secrets That Your Financial Advisor Doesn't Want You to Know. So on this video, I'm going to dispel the 5 myths that are likely preventing you from getting the financial results that you want out of your life. So let's get right into it. So what's the first secret? Well, the first dirty secret that your financial advisor doesn't want you to know is that they get paid no matter what. And in parentheses here it just says MERs, and I'll talk about what that means in a moment. So what do I mean by this? Well, quite simply that no matter what happens in the market, your financial advisor is going to continue to get paid no matter what. Because what happens is that when you give your money to your financial advisor, every single year he receives something that is called an MER, or a management expense ratio. And it simply means this. Let's say, for example, that you gave $100,000 to your financial advisor, and each year he charged you a 2% MER, a 2% management expense ratio. Well, what that means is that every single year, no matter what happens in the market, whether stocks go up, whether stocks go down, whether they just trade sideways and don't produce any gains at all for you, the investor, your advisor is going to continually collect a 2% fee every single year on the total amount of the total value of your account. So even if your account dropped 50%, which was actually not uncommon in 2008, your advisor is still going to continually get paid no matter what happens in the market. So I want you to ask yourself this question. Does that really seem fair that he's collecting fees on your money when he's not directly producing a positive result for you? Does that really seem fair? Something to think about. Now, the second dirty secret is what I call diversification equals diversification. So what do I mean by that? Well, this whole concept of diversifying, or to diversify, is a very, very big buzzword in the financial industry. And simply what it means, of course, is that you don't put all your financial resources in one basket, and that you want to spread your risk around by buying many different companies, many different investments, in order to mitigate your risk. So if one company went down significantly in value, one might go up significantly in value, and that'll balance the risk out. But what a lot of people don't understand and don't realize is that they're not actually really diversified. Because when they go to their financial advisor is very likely only putting them in one asset class. And that asset class that they put them in is called paper assets. And this includes things such as stocks, bonds, and mutual funds. Now, when your advisor sells this to you, he's going to say that, and I'm really emphasizing that, when he sells this to you, he's going to say, okay, here's what we're going to do. He shows you this little pie chart, and he says, okay, so we have you directly diversified. Here we have you in large cap stocks. Here we have you in fixed income securities, and here we have we have foreign stocks. So we're thinking internationally. And here's the thing, though. That's in only one asset class. And when the entire market comes down, everything comes down. So it doesn't matter if you have many different companies in your investment portfolio. When everything drops in value, everything gets killed. Now, because you're only in one asset class, you're not actually diversified, because you're neglecting the 3 other asset classes that would actually tell you whether or not you're diversified. So here's what they are. The first one is paper assets, which is what your advisor sells you. The second one is real assets, as the name implies, real estate. The third one is business, and the last one is commodities. So I want you to ask yourself this question right now. Has your financial advisor ever recommended to you that you go directly invest in real estate, or that you go and start a business, or that you go and invest in commodities such as gold, silver, or oil? Have they ever recommended those things to you? And if they did they just talk about a stock or a mutual fund where you could get exposure to those sectors? Something to think about again. So the third dirty secret is that their job is to sell, not to serve. Now, before I get harpooned by all you financial advisors out here, here's what I mean by this. A financial advisor's income is directly derived from him going out and gaining business and getting more capital to come into his account. And by doing so, he collects, again, what is called the management expense ratio. Now, sometimes it is not advantageous to be directly invested in the market. As we saw in 2008, if you were in a cash position and you were just patient until the market bottomed out, you could have taken advantage of some incredible opportunities that came about as a result of that crash. But the problem is that your financial advisor does not get compensated unless you are directly invested in the market. Now, this creates a bit of a conflict of interest because in order for him to generate an income, he has to continually sell you different investments, different funds, and different vehicles, even though it may not be the right time to do so. So that's why I say it's their job to sell, not necessarily to serve. And just as a caveat, I'm not saying that all financial advisors are like this. Certainly that's not the case. And I'm sure there's a lot more good advisors out there than there is bad. But if you ever doubt this to be true, go watch the movie Inside Job, and it will show you just the amount of corruption and the amount of deceit that exists in the financial industry today. So now we covered that one. The fourth dirty secret is this whole concept that average returns does not equal real returns. So what do I mean by that? Well, one of the tricks your financial advisor uses against you is that when you're directly investing with them, they're going to talk about this concept of average returns. And simply what it means that if you invest over the long haul, they're going to say, well, the stock market has always produced around an 8 to 10% return. So that's an average return. That's not necessarily a real return. And what they've likely shown you is a chart where if you invested, say, $1,000 in the S&P 500 index fund back in 1960, well, they're going to say, well, if you invested here, well, nowadays that would be worth, I haven't looked at one of the charts in a while, maybe $20,000, $30,000 or something like that. And when you look at that, you go, you know what, that actually looks pretty good. This, the concept of investing in the long term, that makes a lot of sense. But here's the thing. That is an average return, not a real return. And what I mean by that is this. Let's say, for example, that one year you invested $10,000 in the market. And let's just say that the market went up 100%. You made a 100% return, which means that your $10,000 would have turned into $20,000. Now let's say that the next year the market dropped by 50%. So now your 20 is back to 10,000 once again. But then the third year, your money goes back up by 100% again. The market rebounds and you recover the losses and you gain 100% return on your money. So now you're back at 20 grand. But then the next year, the fourth year, the market drops again by 50%. Now obviously these are extreme numbers. I'm just using this for illustrative purposes only. But over that period of time of 4 years, your advisor is going to tell you that the average return on that money has been 25%. But in reality, the real return over the course of that time has actually been what? 0%. You haven't gained anything at all. You haven't even moved from your original position. And when they show you those charts of, if you put $100 or $1,000 back in the day and then now it's worth this much, what they don't tell you is that doesn't include things such as their management expense ratios. It doesn't include the taxes that would have been due on that money. It doesn't include inflation, which erodes the value of the dollars that are directly invested. So this is just a trick that they use in order to persuade you in order to directly invest with them. Now, the last dirty secret is that advisors do not necessarily equal rich. Now, what do I mean by that? Well, what a lot of people don't know is that what a lot of people assume actually, is that they assume that their financial advisor must be very well off, that they must be very wealthy, that they must be extremely affluent and rich because they directly give people financial advice. Therefore, they probably know what they're doing. But what a lot of people don't realize is that the average financial advisor, their income is actually only around $50,000 a year. Now, depending on who you are, that might sound like a little bit of money or it might sound like a lot of money. But here's the thing. If you're going to take financial advice from anyone, wouldn't it make sense to take advice from people that are doing exceptionally better than you, people that are doing 10 times better than you, people that have significantly higher net worths and incomes than you do? Wouldn't it make sense to take advice from those people rather than someone that might be earning less money than you are right now? Because let's face it, if you want to get the results that the rich and the wealthy achieve, you have to use the strategies that they're using. And just as an exercise, if you want to see this concept to be true for yourself, I want you to go to the Forbes 400 list and go there and see how many of those people are rich because they invested in mutual funds over the long term. What you're going to find there is that a lot of people on the Forbes 400, they're on there not because they invest in mutual funds, but because they sell them. Big distinction there. So that's what I mean by this concept of financial advisors do not necessarily equal rich. So I really hope you got value out of this video. I really hope this dispelled some of the myths that some financial advisors can use against you in order to persuade you to directly invest with them. So with that being said, I hope you got a lot of value. I really look forward to seeing you on the webinar. We're going to go much more in depth on this concept and many other concepts that relate to the economy, investing today, and how you can position yourself to be on the winning side of the wealth transfer. So with that being said, thank you so much for watching this video. I look forward to seeing you on the webinar, and I'll be speaking with you real soon. Take care.